Hello viewers, today presentation is about the purchase or the investing into three top-notch US ETFs. First one is VTI, the second one is VOO, and the third one is VGT. You all know what those ETFs, these are ETFs offered by Vanguard. VTI invest into total US stock market. VOO ETF invests into S&P 500 and VGT into information technology. So today we are going to do a deep dive to see should we buy all three of these ETFs, or is there any overlapping between the two or three? So what should be the strategy? So let's begin with this analysis. As I said, VTI, which is Vanguard Total Stock Index ETF, invests in 100% of US stock market and includes large, mid, small, and micro cap stocks. Its top 10 holdings are such as Microsoft 5%, Apple 6%, Nvidia 5%, Amazon 3%, Meta Platforms 2%, Alphabet Incorporated 3%, Berkshire 1%, Broadcom 1%. So around top 10 or 8 technology companies are the part of this ETF. MER for this VTI, which is MER, is management expense ratio that you have to pay to Vanguard to hold this ETF, is 0.03%, almost negligible. Assets under management as of end of 2024 was US dollar 1.8 trillion, and average daily volume that been traded for this ETF is about 4 million. Annual yield is 1.3%. Beta for this one is 1.02. As you know, beta reflects that how the ETFs moves when the total stock market moves. Simply, if there's an increase of 1% in a stock market, this ETF VTI will increase by 1.02%. Second one is VOO, Vanguard S&P 500 index, that where they invest. It has almost similar kind of top-notch companies, and especially about 80 to 90% is the overlapping between VTI and VOO. Microsoft share is 6%, slightly higher than in VTI of 5%. Apple share is 7%, Nvidia 7%, Amazon 4%, Meta Platforms 2%, Alphabet 4%, Berkshire 2%, and Broadcom 1%. So it's almost similar to what the investment strategy is for the VTI. MER is also similar to VTI, 0.03%. Assets under management are 1.4 trillion US dollars. Average volume is a little bit higher than the VTI, which is 6 billion. Beta is 1%. So it means that whatever the market movement is, the ETF replicates the same movement. So if there is a 1% increase in stock market S&P 500, 1% ETF price will also increase. The third one is VGT, Vanguard Information Technology Index. It invests to track the performance of the MSCI US Index, Information Technology Index, and includes stocks of large, mid-sized, and small companies. So this is the ETF that invests 100% into information technology. And you can see from here is that the Microsoft investment is 17%, Apple 15%, Nvidia 12%, Broadcom 4%, Salesforce 2%, Advanced Micro Devices 2%, Adobe 2%, Cisco 2%, Oracle 1%. So it's all 99.9% investment into information technology. Its MER is a little higher, it's 0.1%, and AUM is 91 billion US dollars. Average volume 420 8,000 per day, which is very small compared to VOO and VTI. And VGT is a very, very specialized ETFs because it's very few people are taking that much of a risk to invest just into the highest volatile sector of the US, which is technology. So annual yield is 0.7%, and beta is way higher than 1.25, which means that if the technology sector increases by 1%, your ETF would increase by 1.25%. So now let's quickly look into the sector allocation of VTI, VEO, and VGT ETFs. VTI invests 31% into technology, 14% in financial services. Healthcare is 11%, consumer cyclical 11%, communication services 8%, industrial 9%, consumer defensive 5%, energy 4%, real estate 3%, utilities 3%, and basic materials 2%. Now compare this with the VOO. So VOO means the S&P 500 ETF. Technology 33%, so 31% versus 33%, not much of a difference. It's almost overlapping. The two are similar to each other. Financial services of VEO is 13%, healthcare investment 11%, consumer cyclical 11%, exactly the same as VTI. Communication services 9%, industrial 8%, consumer defensive 6%. So overall, you can see from the slide above that you are seeing on this on your screen, VEO and VTI replicate each other. They are very much similar, so we should expect return as well similar. Contrary to these VTI and VEO ETFs, VGT invests 99%, almost everything, into information technology index. So after having a slight idea of how these three ETFs function, let's look at the performance of all three ETFs. Definitely, as I said earlier, we should expect similar return or similar price movements or similar performance of VTI and VEO. So I can see in the first, if on the basis of 1 year time period, VTI and VEO both increased by 34% in value, while VGT increased by 36%. If you look into a little bit of broader view and longer time period, over the 3 years period, VTI recorded 10% gains in prices, VO 11%, and VGT 13%. So consistently you are seeing that VGT is performing better because it's more volatile, and of course its beta was telling us this thing. So the performance of VGT is a bit better than VGT and VTI. Oh, sorry, with VEO and VTI. Based on the 5 years period, VTI increased by 15% per annum, VOO by 16%, and VGT 22%. So it's much higher compared with the other two, VTI and VOO. And over a 10 years period, 13% for VGT, for VOO and VTI, and 21% for VGT. So consistently you can see that VGT has performed much better than the other two ETFs, but there's more risk because if we look into the next slide here, that you can see on your screen, on the year-to-year basis, in 2024, by the end of the year, it was December 24, VTI posted 28% gain, VOO also posted 28% gain, but VGT increased by 30%. In 2023, VGT increased by 53%. It was a special year for information technology sector, and 53% gain was recorded into VGT, whereas VTI and VEO increased by 26% each. 2022, we all know that it was a year with high inflation and higher interest rates. So we have seen a sharp decline in all three ETFs. VTI declined by 20%, VOO by 18%, but VGT declined by 30%. So you can see higher gains when the market is good, higher losses when the market is bad for VGT, because VGT is a very volatile and sensitive and risky ETF. So on and so on and so on. So you can see that over the last 10 years period that we have shown here, VGT has performed better when the market was good, but it performed poorer than other two ETFs when the market was bad. So now the big question. The big question is that if I have, suppose, $100,000 and I want to invest into these three ETFs, what should I do? I am not a financial advisor, and this video is only for information and entertainment, so don't take my words as granted. But by looking into this analysis, but I think that VTI and VEO are overlapping each other. Their return is the same, their investment strategy is similar, their AUM is similar, their MER is similar. So why would I invest into VTI and VEO? Why not I decide that which one of those two should I pick? If you want to invest into entire US market, which is like, means that you want to diversify at a very, very large scale, then VTI is a better investment ETF. But if you want to invest into S&P 500, so go for VOO. So if I have $100,000 in my pocket and I decide to invest, what I would do, I would spend 70% of that 100,000, which is $70,000, into VOO or VTI. And the remaining 30%, I will invest into VGT. And the reason why spending 30% in VGT is because VGT is very risky ETF. And I don't want to take a big, dent if in case market performs badly in coming years. So this is food for thought. My suggestion is this. So see you in the next video. Till then, bye-bye.